we get to absorb something else because we are live on Facebook for the Tuesday edition of the Not Your Average Investor Show. I am your host, Pablo Gonzalez. With me as always, thank goodness he's back. They call him GC because he's a gentleman, cavalier, and because his name is Greg Cohen. Welcome, Greg. Say hi to everybody.
Hello, everybody. Good to be with you here. Pablo, what the heck did you do last week when you didn't have the GC moniker to throw in the mix there?
You know, it's harder to come up with 100 different variations of one name than it is to come up with one hype man intro. I think I described Mike Stetson as the consummate outdoorsman, and I forgot what the hype man intro.
I watched it. It was good. I was happy for you, and I was also sad that I didn't understand what my name was that day. So
that's right. He was the LeBron James because he was employee number 6, right?
That's right.
All right. So everybody, welcome if you're joining us today in Zoom. So happy to have you here with us. We see our regulars, Lee Bishop, John Hanning, Jake Hargrove, Bill Shields, Marilyn already saying hello, everybody. For those of you that are joining us for the first time, this is an interactive show and we want to hear from you. And there's 2 ways to do that. You see that our fellow attendees here have been putting it in the chat box. The only way you see that they're typing in the chat box is because when they pop open that chat, they hit that blue button that says panelists. They drop that down and they drop it to panelists and attendees. So everybody can chat and everybody can see it. If not, only we see it, right? So we want everybody interacting here, make a relationship. Sometimes there is a lot of value add in there that people can contribute in the chat. And then second is, I want you asking questions that I can ask the Greg Cohen over here. And the best way to do that is to pop open the Q&A and put it in the Q&A box. And the reason why is, number 1, I don't want to go cross-eyed trying to keep track of everything, though I try. But number 2, that chat box scrolls up a lot, right? There's way more interaction in there. So it's much easier for me to keep track of the Q&A than it is the chat. Hello, Ruel Papa from cold Minnesota. Man, I heard it was snowing up there. Ruel, you are a perfect example. You are only chatting with us right now. If you can hit that blue button where it says panelists and put panelists and attendees, everybody else can see that you're from Minnesota. And I heard that it was snowing up there. We're in Florida, as you may or may not know. And last but not least, if you like what you're hearing, you want to hear the show again, you want to listen to past episodes, you want to see our past property breakdowns of the week, you want to sign up for our free investor toolkit, and watch Greg's webinar. We have all centralized it. You want to see the podcast. We've centralized it all in one convenient location. It's notyouravageinvestorshow.com. That is where you go as soon as this show is over and you want more Greg Cohen. That's where you got to go. So we made it real easy. I'm going to put it here in the chat box, but without further ado, the question of the day, GC, is, are we in a real estate bubble right now? But before we ask that question, because at the end of the day, I'm sure that you have an amazing argument about whether it looks like or it doesn't look like we're in a real estate bubble, right? But really nobody knows without hindsight when we're in a bubble, when that pops, whatever that is. And we happen to have a really recent bubble pop that has affected all of us, right? The 2008 financial disaster. So before we decree whether or not right now we're in a bubble, I would love for you to take me back to the last bubble that you experienced and tell me where your head was at. And at the end of the day, spoiler alert, right? JWB started at the top of the market, right? So
we did.
So they have some experience in buying things right at the bubble. So Greg, first of all, tell me where your head was at the last bubble. Did you know that we were in a bubble?
Absolutely not. And we're going to go through some indicators here that's going to help everybody here make your own decisions, not just for right here, right now, but it'll help you as you're investing for the next 3, 5, 10, 20 years. These indications are going to help you. But the truth is that JWB started at the absolute worst time. And of course, hindsight is always 2020. We now know that JWB started in the absolute epitome, probably the biggest real estate bubble. We started at the absolute top of it. And our whole method of doing this was to buy real estate at the absolute top, right? And, you know, when I started, I was 23. I mean, if you could think of a story that is probably going to lead to failure, it would involve some snot-nosed kids, 2 or 3 friends who were 23 years old, who had read a few books, who set out to quit their jobs to go out and start a company. It happened to be in real estate, and they started to buy dozens and dozens and dozens of rental properties in 2006 and 2007 at the height of the market with high interest debt. How would that story end for you, Pablo?
It doesn't sound very positive. It sounds like one of these. What do you call it? Not a warning story. Buyer beware. No, man, I can't. I can't think of the.
You name it. It was bad, right? We were not set up for success there, and I think we would all agree on that. But there's one difference that meant success for us. There's one difference that we have done and started to do early on that allowed this to be a success story, which we're going to get into. And that one difference is that we were buying based on cash flow and appreciation. While the rest of the world who was buying real estate was only focusing on appreciation, we were buying assets that pay for themselves every single week. And that is the big difference. That's why every week when we talk about our properties of the week breakdown that we do on Thursdays, or when it comes up here on Tuesdays, we talk about buying assets and not liabilities. We bought about 40 rental properties in the first year and a half. My business partners and I, 23 years old, borrowed really to the hilt in the beginning to do this. And the only reason that it made sense that we still were able to keep those properties through the bubble bursting and then still own those today and a lot more is because we understood the power of cash flow. We understood the power of positive cash flow. But it wasn't always so rosy. There were some really, really tough times in the beginning. I mean, if you can think back to, a dream that you have and you work so hard, you are dealing with, a lot of naysayers. I mean, I remember when I left my job in corporate America, everybody was literally laughing at me. I had directors that were, 2 levels up that were, mocking me, saying that I was going to go and be the next Donald Trump. And it really hurt me. I mean, nobody believed that I was making a sound move to go into real estate. And that's back before people thought that there was an actual bubble. Like, people saw values going up. They just thought it was such a stupid idea to go out and start a business and that I was destined for failure because I was an entrepreneur. Right. So I kind of overcame all of that. And then, even within your own friends and your family, there are people that doubt you. And I dealt with that. Right. And then you overcome that. And then you get to the point where you need to raise capital and you need to actually complete a deal. And we did that. We did that a few times, and I overcame all these hurdles. And then I had to deal with something that nobody in my lifetime had ever dealt with. And that was what happened to real estate prices from 2007 to 2011, right? Everything I had worked so hard for, the assets that I had built up, the assets for the clients that I was managing at that time, I was concerned because I knew the fundamentals of how positive cash flow works and the buy and hold mentality, but I had never actually been through it. And so there were definitely some very scary nights, some sleepless nights in the beginning of 2007 as market values started to decline, what would eventually be over 35%, and to actually live through the bubble when every bit of money that I had at that moment was invested, and then a whole lot more that I had borrowed. So it was pretty tough. It was tough in the beginning.
So it was tough psychologically, I imagine, right? Like you're owning this portfolio of assets, and on paper it seems like you're worth way less than you are. But how did it manifest, cash flow wise in your bank account? Talk to me about what you were going through at that time.
So you're hearing all of this noise. When you buy at the height of a market, you're hearing all of this noise. Everybody on the news is talking about market values dropping, how people are losing lots and lots of wealth, right? And you're hearing all this, but it was I was living a different reality than everybody else, right? Because everybody else was buying on speculation, right? They were buying brand new construction homes and putting massive amounts of down payment on them. And they were expecting that those were going to go up 100% in value overnight. But they weren't getting any positive cash flow from it. I was living a different reality because I was hearing all the noise and then thinking that I should be scared, but I was looking at my bank account every single month. And this is why JWB clients invest in positive cash flow properties. It's because the different reality that I was working with, that I was living, was looking at the 40 rental properties that I owned and seeing positive cash flow come in every single month. And that was keeping the lights on at JWB, right? There were other struggles that we had, but the rental properties were the thing that kept performing for us. And so it was, I remember living like a dual reality where everybody else was freaking out. As I was starting to go through it, I was looking at the rental income coming in, and I understood that that meant success. And because the thing that I really didn't care about was what my worth was on paper. I think even today, that's about the biggest, I don't know. It means nothing to me, right? Like people can come up with financial statements that they're worth hundreds of millions of dollars or not. It doesn't matter to me, right? At that moment too, back in 2007, as real estate values plummeted, what I owed on the properties was more than what I could have sold them for at that point. So my net worth was probably negative at that point, but it didn't bother me because it didn't matter. What mattered was cash flow was coming in, that I had the assets. And I also knew that long-term, given a full market cycle, real estate values come back to historical norms. So the least important thing out of everything there was, what am I worth on paper in 2007? It didn't affect my quality of life. It didn't affect my family. It didn't affect my business at all. And so once I overcame that and I shut out all that other noise, I was okay. I was happy. I was happy with my real estate investments, contrary to what everybody else was feeling.
Interesting, man. So during that time, I was in the construction side, right? Like I was running a operation for a Fortune 500 subcontractor that catered to, it was in Orange County, California, right? So we were one of the few branches. Most of our branches cater to tract homes. So it was like Pulte's, Lennar's, D.R. Horton's, right? Those people kicked in the teeth, right? But we also I was in Orange County, so I had a bigger percentage of custom family homes as well. And I had a bunch of clients that were just, I mean, it wasn't fix and flip, but it was like buy a house, tear it down, and then rebuild it, and then hope to sell it. So it was basically like a flip, and they all lost everything. When JWB started, were you already on this buy and hold path, or were you starting with fix and flip or anything like that too?
Well, when we started, we did a little bit of everything. And we got kicked in the teeth in other places. When we were flipping properties during the turn, we got kicked in the teeth a lot. But the rental properties, that was a part of our plan. So we bought about 40 in the first year and a half. That was our basis. I mean, that's what my business partners and I felt as being our retirement at some point, 10, 15 years down the road. So it was pain in other parts of JWB, but the rental properties were performing. And that's what we did. We had no clue that we were investing in a bubble, right? We had no clue that we were investing at the top of the market. You know, the fundamentals that we learned taught us that it didn't matter if you're in for the long haul, which is a different thing than most people realize, right? If you buy and hold rental properties, what we're talking about pricing today, what we're talking about potentially being in a bubble, we're going to look at that. But honestly, it doesn't matter if you give real estate a full market cycle, because history shows us, and the data that I'm going to share with you, is that market values come back to the norm given a full market cycle, right? So the least important part of what's going on today as far as buying rental property decisions is short-term pricing. If you are involved for a full market cycle, which is known to be between 10 to 20 years. That's how I've made every decision with a rental property that I've purchased. That's why we're buying more today than we did last year. We'll buy more in 2021 than we did in 2020. It's because the buy and hold mentality is king. That's what allows this to be something where you don't have to check the stock ticker and check the pricing today or tomorrow. If you just understand that crystallized concept, which is real estate values come back to the norm.
Great. And for those of you joining us, right, like we wanted to have this discussion first to talk conceptually about this, so that now when we talk, so we're now going to show you exactly what it looks like to have bought at the worst moment in the economy and what that meant for Greg's pocketbook, right? We're going to show you that. And then we're going to talk about the dynamics of what creates a bubble, right? But we wanted to let people join, right? Like we kind of reached the peak of how many people we have right now. So we wanted people to join. And we also want you to understand that whether or not we are in a bubble is a great question, but it may not be the question you need to be asking, right? Like at the end of the day, depending on what your criteria is. So, Greg, talk to me about then. Let's talk about a home that you bought that we recently showed on the Not Your Average Investor show, right?
Yeah.
That you
This one.
purchased at the top of the market, right? Like when did what was it? You bought it December 2007,
Yeah.
right? I'm gonna
I didn't.
pop it on the screen. Talk me through it.
Yeah, absolutely. Well, so I didn't realize just how much at the height of the market we bought this property until I just went and actually pulled the date. But let me just give you some context. You guys are looking at a graph here. Let me show you what that is. And then you guys are going to love the fact that if you want to talk about what it actually feels like to buy in a bubble, there's not a greater indication than what I'm going to show you right here. This is the best example of buying in a bubble in the world. So what we're looking at here is a graph of Jacksonville's historical home pricing data. The blue lines that are jagged go up and down every single month, right? Those are the median home sales prices in Jacksonville. The red line that's smooth and going up, that's actually going up at a rate of 4.3% per year. That is the historically accurate home price appreciation rate on average for Jacksonville. This is something that comes from the Federal Housing Finance Agency. This goes back from 1991 all the way through present day. If you looked at the actual median home prices in Jacksonville, you would see that on average, every year we appreciate at 4.3% per year. And that's important to know because, again, as buy and hold investors, that's what you can count on given in your investment timeline of being a full market cycle. Now, what you're looking at here is interesting because when we talk about a bubble, there's an actual physical representation on this map, on this graph of what a bubble is, right? For those who are listening on the podcast or may not be seeing the screen here, right? We're looking from 2001 to 2007 as being this tremendous rise of median home sales prices in Jacksonville above what the historically accurate home price tells us we should have been at. So when people are talking about a bubble, they're really talking about home prices should be at this level. We are way above this level. And there's not a better graphical representation than what happened from 2001 to 2007.
So the difference between the median price and the historical median price is this, right? Is this spread between the blue line and the red line in between here that you can see in the graph that we're showing. If you're listening to podcasts to us in the future, welcome. But then you also have, so the median sales price there is $223,000, which is what you bought this home for, right? Around there.
Mm-hmm.
And at the time, if I was to eyeball it, right, like it should have been somewhere around 135, 140,000, right? To be historically correct. So there's a huge spread between the historical median home price and the actual market median home price. But then you have our famous indicator here, MOI, right? Months of inventory that says 18.07. That's not represented in this graph, but can you talk about that right now?
Absolutely. So there's a couple of metrics that I want you to take away from today's conversation. When you're talking about whether or not we're in a bubble, you want to look at the first thing we just discussed. Where is your median home price in comparison to what the historically accurate median home price should be, right? That is one indicator, right? The next indicator is months of inventory. Months of inventory is more of a short-term indicator. And what months of inventory tells you is how many homes are on the market in your area, and then how many months would it take to fully exhaust all of that inventory through home sales. And this is a great indicator because it's just like any other business. If you have a ton of inventory in whatever business you operate, and you had very low sales last month, you are going to be in a tough spot, right? You're going to have downward pressure on prices because nobody's buying your stuff and you got way too much inventory, right? And the opposite is true. If you're an entrepreneur, if you're a business owner, and you have very limited inventory and your sales were off the charts last month, you're going to have pressure to raise your prices. And it's the same way in a real estate market. So months of inventory is incredibly important. If you're a fan of the show and you watch the show, and if you're a JWB client, you get our newsletter, we talk about months of inventory all the time. We started to track it monthly back in 2014. And we do it every month now. Historically, what you'll find is an equilibrium market for months of inventory is between 6 to 7 months of inventory. And an equilibrium market, sometimes people get this confused. Equilibrium market means that you should see historically accurate home price appreciation. So if you're over 7 months of inventory, that doesn't mean that value should decline, right? The higher you get above 7 months of inventory, the greater the downward pressure, and eventually you would see price declines. And then the opposite.
It's directly correlated. So the higher the months of inventory above the historical average means lower rate of appreciation in general, right?
Exactly.
Just because it's, so, you know, I was an economics major, right? Like maybe I can actually add some expertise here, but supply and demand dynamics, right? Like the greater the supply, the lower the demand, you know, and the demand stays the same, it lowers the price, right?
Yes.
So then the other way around, the less supply there is in relation to the demand increases the price, right?
Exactly. Right.
Okay.
Given the same demand, if your supply is lower, your prices are going to go up.
Yeah. Yeah. Okay. So then in 2007, it was 18 months of inventory, right? So historically average for it to go 4.3% appreciation is 7-8,
6 to 7.
6 to 7. So it's 3x, right?
Crazy.
When you bought this home. Okay. So I want to get to like the stats of where we're at and our decree of where the bubble is, right? So then tell me, this home that you bought here, how did it perform for you until, you know, is there a difference in the performance of this home if for the first 5 years versus now? I mean, does this graph that is so wildly changing, or was your cash flow the same the whole time? Like, or at least explain it to me in relation to the property breakdowns that we do on Thursdays.
Yeah. Call it a 10% return is what we were getting on our cash flows, right? That's your rate of return for your profit centers, all of them except home price appreciation, right? The things that you basically can control and that happen to you on a monthly basis, right? So our rate of return was around 10% on the assets there, right? We experienced that same rate of return basically through the downturn, right? Because big companies didn't leave Jacksonville. The job base didn't leave Jacksonville, right? People could still afford to pay their rent, even though home values went down dramatically. And so rental income was consistent and rent prices were largely consistent as well. So for the first 5 years from 2007 to 2012, it was basically the same. Like I was living the exact same thing, no matter if prices had gone up 100% versus down 35%, most likely, right? My rental income hadn't changed at all. My quality of life hadn't changed at all. So for the 5 years after I purchased this one, not much change in my bank account.
Okay. So then that the rate of return that we normally show on the Thursday show, that is right now between 9 and 11, right? That stayed consistent. That is why on those property evaluations, you never include home price appreciation because you want people thinking about that. And then the other thing that you like to say on the Thursday show is that, you know, this is for long-term, actually on every show, right? This is a long-term investment thing, right? If you are buying a JWB house, you are looking for people that are looking to invest for 10 years at minimum in general, right? Can you, so
Yeah.
Go ahead.
Well, I'd say my job is to help you produce your best return on investment. The best way that I know to produce the best return on investment for you is for you to buy and hold for a full market cycle, because that's when you can count on home price appreciation. We accept clients to invest for a minimum of 5 years. That's the absolute minimum. But that's the reason why I don't put it in the property valuations, because if you're only investing for 5 years, I find real estate appreciation to be highly speculative, right? And that's why we don't put it into our home to our property valuations. I think you can count on it when you get into the full market cycle conversation, which is, I mean, that's why, as I saw market falling from 2007, 2008, 2009, 2010, right? While everybody else was selling out and selling at the bottom or near the bottom, that was never a thought for my business partners and I, because we believed that market values return to the norm. And if you believe that the market values return to the norm and your cash flow is consistent and earning that return that you need, why on earth would you sell at the bottom, right? We expected this to happen, to come back later on. And, the fundamentals taught us that, and that's how it worked out.
Makes perfect sense, man. So, this is going to be hard to explain for the podcast, but like if you think about it in 5 years, it kind of goes from this like top of market price to almost bottom of market price. But if you think about it in 10 years, it goes from this top of market price to slightly higher than before. So there still would be appreciation, not, given that you are perfectly timing the worst time to buy, right?
Yeah.
You're not going to get 4.3% appreciation, but you're still going to get the returns that have been calculated inside that spreadsheet and plus a little bit more in 10 years, given the worst case scenario example of the last 100 years.
Yeah, exactly. We don't put any appreciation in the evaluations. We get clients who want to earn between 9 to 11%. You don't need any appreciation to earn between 9 to 11%. It's always a bonus on top. But if you're timing the worst absolute time to buy a property at the absolute height of the biggest bubble we probably will ever see in our lifetime, I ran the numbers on it. From that moment till today, you're still experiencing 2.67% appreciation.
Boom. There you go. Yeah. That's incredible. All right. So we just spent 20 minutes talking about how whether it's a bubble, even if you time it at the worst, right? Like if you're the best bubble timer of all time at bad things,
Which
that
I
is
was.
which you were, by the way,
that.
you won that one. That's
that was
nice.
Huge.
I'm gonna get you a trophy. Cool. Okay. So we've got that piece figured out, Greg. So now talk to me about current market conditions. Do you think we're in a bubble? Dance around.
Well, you obviously know that I don't think we're in a bubble, right? Everybody on the call would expect me to say that I don't think we're in a bubble. I mean, look at where we are. If you want to ask somebody how they really feel, and it's not just a talking head, see what they're doing with their money, right? You guys are seeing how we are purchasing 600, 700 properties each year. We've done that for the last, 5 years, right? Every single year, people have said, do you think that we're in a bubble, Greg, because we saw 6% appreciation last year or 8% appreciation last year? They've been saying that for 3 years or 4 years. People talk about more if we're in a bubble today than they did when we were actually in a bubble in 2006. I never heard that we were in a bubble in 2006 and 2007, as shocking as that may seem. So if you want to find what people really think about whether or not we're in a bubble, see where they're spending their money. We're buying more today than we did last year. If you're seeing about how we're investing even in downtown Jacksonville, right? You wouldn't do those things if you thought that there was a bubble. And so I think you all know that that's how I feel about it, but I really want to arm you with the same data that I'm using to make those decisions so that you guys can make the decision for yourself.
Cool. Let's talk data. Well, first of all, I guess you've used the term bubble a lot, right? So there's a distinction between higher than average home price appreciation that is not going to be there all the time, and bubble, right? Like what's the difference there?
I think let's go to the graph, because I think that helps people see, right? So people get concerned because our minds are fresh about what happened in 2008, right? 2007 to 2011. They see the decline that happened. It was a very emotional part of a lot of our, either professional careers, our family upbringing. I mean, we all lived that. It wasn't that long ago. It's still fresh in our minds. But we need to understand the full picture when we determine whether or not that's a bubble or not, or is that just above average home price appreciation recently, which is a market correctness, right? This graph really gives you that information, right? If you just looked from 2011 to 2020, you would see higher than normal home price appreciation. We know that because we were way below the median home sales price expectation in 2011. We were way below it, right? We were at about 125,000, let's call it. And the market should have been priced at about 170,000, right? So we were way below it. And this belief that I keep sharing with you that markets return to the norm would guide you to believe that if you're going to catch up to that 4.3% trend line, you have to have higher than 4.3% appreciation to get there. And that would be a market correction, which is what we believe that we're seeing.
Got it. So, again, this is very recent, right? But like, it seems like now at the height of demand in the short periods, it's like right along that line / a little bit higher, but still in the down, in the small ups and downs that happen intra year, it is still below the line, right? So like, it seems like it's headed towards being on that line. So that 4.3, at least in the next window, seems like a fair assessment. Let's talk, or is that right?
That is right, but I want to caution one thing, right? We're focusing a lot on the line and we're focusing a lot on what the median home sales price is, right? When you see a big gap, that may be an indication that it is a bubble. That may be. That doesn't necessarily mean it's a bubble, right? That means that JWB better be paying attention to this and understanding what's going on, right? Now, that what normally happens in healthy real estate markets is that your values go a little bit above the line and they go a little bit below the line and they go a little bit above the line and they go a little bit below the line. So that's normal. So I don't want all of our listeners to key in on this line and think the minute that it goes above that line, that means that we're in a bubble. That would be inaccurate, right? If you looked at this since 1991, you'd see up and down, up and down, up and down. Now from 2001 to 2006, you'd see a big up and then a big down, which is not normal. But it's very normal for you to go above and below and above and below. That's just how it goes.
Got it. So a normal line would be like kind of what I'm drawing here with my cursor that would kind of slice through the peaks and valleys there. So let's talk data, man. Let's talk the data that you like to call upon. Of course, you're putting your money where your mouth is, right? So we know that you're buying a ton. So your behavior shows that you don't believe that it's a bubble, but tell us why, tell us how you've come to that conclusion.
Well, this months of inventory is the second part of really the data that serves us and serves our clients to make sure that we're one step ahead as far as where the market's going. Months of inventory is such a great leading indicator for the short run. Think about it, maybe the next 6 to 12 months. And when you look at some of this data that I'm going to share with you right now, it's absolutely staggering what MOI is telling us. So what I did here, for those who can't see this, is I put some historical perspective. So I wanted you to see just the amount of inventory that we had on the market, the low amount of sales that we had on the market, and the high months of inventory that we had at the real height of a real bubble, which was December 2007, which is when I was buying my rental properties. We had over 16,000 houses on the market in Jacksonville in that month. We only had 905 sales that month, which gave us a months of inventory of over 18. I have never, since I've been tracking this, never seen 18 months of inventory, never even gotten close. This was the actual height of the bubble. So it's good to understand what a bubble really looks like. And then when you're starting to look at what has happened over maybe the next, I pulled the data from September of 2014. I pulled it from September of 2017 and September of 2020. What jumps out to you, Pablo, when you're looking at some of this data?
I mean, it shows a trend of diminishing months of inventory, right? I would assume that 2014 to 2017 was somewhat stable-ish because the months of inventory goes from 4.89 to 4.1. But it seems like right now there's an exaggerated demand for Jacksonville homes and a severe glut because we have 5,500 homes on the market and 3,100 sales per month, and puts it at 1.76 months of inventory. And from my own perspective of looking for homes to buy in Jacksonville, I know that email I get from Alex every day, if I'm not sending it to my realtor to get an appointment that morning, I generally don't get to see it before somebody puts it under contract. So
yeah, if you're a business owner and you have 5,549 widgets and you sold 3,158 last month, are you more likely to increase your prices or decrease your prices?
I'd be likely to increase my prices and build a new factory.
There you go, right? Well, and if somebody came to you and said, well, I think that your prices are overly inflated and that the demand really can't support it. I think it's artificially too high. But you were looking at your sales and you saw 3,100 and you only had 5,500 in inventory. What would you say?
Market's the market, right? Like people want it.
Yeah. 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 And then if you're historically your widget prices followed this line, right? And they had historically gone up to be exactly what that historical home price had been and told you they should be, would you feel even better about raising your prices?
I kind of lost you in the question. I'm assuming my I was trying to do the math in my head of what this is, right? Like I was trying to think of, if your warehouse is supposed to be empty, every like 4 months, 7 months, and what you have is just like a stockpile of 1.5 months worth, and that your supply is coming from China and it takes 2 months, I'd be freaking out. Yeah, I would be. I'd be raising my prices so that I still have the product to sell to people at the same, at a higher price and a higher margin, instead of having people come to me and saying I'm out of inventory.
Yeah, exactly.
Yeah.
So,
yeah.
Well, I think you're exactly right. I mean, the chances that you feel like your prices being that high, being short-lived would be pretty low in my opinion, if you're looking at your sales that you just had for the last few months and they were so high. And so this is why this indication, you just can't look at this number by itself and say, are we in a bubble or are we not in a bubble, right? If I put 1.76 in front of you as a month of inventory, that doesn't mean whether we're in a bubble or not, right? It's a leading indicator that you would expect to see an upward pressure on prices. But that's why you need both of these metrics, right? This right here signifies a significant lack of supply, right? We only have 5,500 homes on the market. We used to have 7,100 or 8,800 3 years ago and 6 years ago. And 13 years ago, we had 16,000 houses on the market. We only have 5,500 now. So there's a severe lack of supply, right? So this is one data point.
We got a couple good questions here in the chat before we move on to the next data point. Jackie Hung asks, where are you getting this historic data?
Well, this is all coming from the Jacksonville Multiple Listing Service. So Northeast Florida Multiple Listing Service is where we're pulling all of this data. The data as far as the historically accurate home price appreciation for Jacksonville comes from the Federal Housing Finance Agency. And for those of you who are in the group, if you want to go and look at past videos, I actually walked through exactly how you can pull that data for yourself. I literally just did a screenshot of me pulling that data. So you can go there, or you can just, go to the Federal Housing Finance Agency. You have to click a few places and figure it out. But it's there for you.
Great. And Greg's talking about our Facebook group that has 1,800 investors. That is our little cool club where we all hang out in between calls. And we would love to have you there if you haven't joined that yet. You go to jwbfacebookgroup.com. I'll put it here in the chat. Second good question here in the chat. Miguel Angel Sanudo asks, and what is happening since COVID, March 2020? What's happened to MOI since then, Greg?
It's gone down. Continues to go down. That's right. You're seeing some trends that are materializing now as a reaction to COVID, which are dropping your months of inventory, which is still giving upward pressure to pricing. I mean, that's why we looked at months of inventory back when COVID broke, and we came on the show and told all of our investors that we did not expect prices to go down, where nearly everybody else said that prices were going to go down. And the reason that we did not see prices going down is because we had really low months of inventory. The data was showing us that we could have seen sales decline and still not see price declines happening. Now, as it turned out, interest rates went way to the bottom. That increases demand. And then you're also seeing net migration come into Jacksonville from places like New York and all of those higher priced, higher density cities up there without the great weather that we have. And people are moving to places like Jacksonville in droves, and that's increasing demand considerably. And inventory levels just haven't risen. A lot of people are not putting their houses on the market, especially if they're occupied, because people don't want to have random people in their houses right now. So everything that has happened post-COVID has worked out the way that we thought it would, but to a much higher degree.
Yeah.
Right. I mean, I did not come out here and say that I thought prices were going to rise as much as they did. I just said that they weren't going to fall. As it turned out, all of these factors have increased demand and kept supply low.
If I remember correctly, it was something around like 3 point something, and you're like, it's not going to drop because we're still below this 7 month. We're still super low on that, and now it's down to 1.76. And the other thing that I definitely remember correctly was the first time that you came out and spoke about it, and you're like, guys, I don't think it's going to drop. And then this was kind of at the beginning of us starting our content show, and we were like we're getting our flow of like repurposing thing and what we're going to post, and you're like, Pablo, I want you to go in there and cut that part out. I'm so nervous. I remember you asking me to be like, listen, can you just cut out the part that I said I don't think it's going to drop, because I'm just nervous. I don't want to come out wrong. And I'm like, Greg, you said it. It's there. Now we'll get to point back at it. So I'm glad. I'm glad we were having these conversations then, man, because we actually need to uncover that clip, by the way.
I know it's there. It's there. We said it. That's what we believe. That's what we share with all of our clients. And then I'm like, oh man, I'm really taking a risk there.
Yeah, I remember. So Miguel Angel, to answer your question, he said it's gone down, which essentially means, the months of inventory have gone from below where it needs to be for regular appreciation to way lower, which increases the appreciation. So what's the other data point, Greg? Talk to me. Should I just scroll up here?
Yeah. So let's go down to this graph. So when you're trying to decide, and when you're talking to your friends and your family and your realtor and everybody else who's involved in your success with your rental property investing career, right? And they ask you if you're in a bubble, go to a chart like this, go to a graph like this, right? Look at where we are in the median home sales price expected level. That's that red line. And look where our median home sales price for your market is today. If you are around that red line in this chart, right? If you're around what the historically accurate expected value for your median home price should be, that's an indication that you're probably not in a bubble. Okay. If you then look at months of inventory data, that is something to supplement this as well. Supplement in the basically telling you where you see prices going in the next maybe 6 to 12 months. If you see if you see a months of inventory level of 1.76, really anything below 6 and the lower below 6 that you go, that is more and more of an indication that you do not expect to see prices drop. We'll just leave it at that, right? So these are the two indications that JWB is looking at on behalf of our clients, on behalf of us as owners. My business partners and I own rental properties in the same neighborhoods you do. And when we look at this data, it does not tell us that we are anywhere close to a bubble. And we do believe that we're going to see some economic damage resulting from coronavirus in the coming years, right? You are going to see permanent job loss, right? We've got sort of this pumped up economy right now with a lot of the stimulus that has been here for all of us that is going to go away at some point. There is pain that is going to be coming. But when you're looking at 1.76 months of inventory and you're looking at the really low rate of foreclosures that we have even prior to coronavirus, even prior to COVID, there's a lot of runway for damage to come to the economy before you would start to see prices decline, is how we feel.
Right. And, I feel blessed to say you're talking about that paper home, the paper price of your home, whether you live in it or whether it's an investment home, right? Because Lee Bishop here writes, not sure if the loans for education not being repaid is going to create a housing bubble, but I think the COVID-19 pandemic is creating a seller's market for a while due to everybody moving out of apartments and into affordable living, like our favorite rental properties with turnkey solutions like JWB, right? So at the end of the day, the pain that's coming to the economy will still have, there will still be people that need to live in C plus neighborhoods that at the end of the day need shelter, and it's an essential need, which is something that we realized during COVID.
Yeah. And, there are some trends that are being accelerated that people were feeling for a while. And then there are some that are sort of like heightened right now, right? Nobody right now wants to live in a dense population. I think that is kind of in between, right? That's something that people have probably been feeling for a while, maybe accelerated, but it's definitely heightened for where we are and temporary because of COVID, right? 2 years, 3 years from now, you're not going to be seeing the exodus to single family homes from apartments that you are today. You will see some, because that was happening even prior to COVID, but probably not to that degree, right? But when you think about people moving from the Northeast to Jacksonville, that's kind of the same line of thinking, right? People have been wanting to do that for a long time. Work is changing for everybody now. People aren't tethered to their job like they used to be. And if that was the only thing holding them back for living in New York and dealing with the snow, you're going to see more and more people come, more and more population growth come to Jacksonville, especially with us being an affordable market in Florida, which is not very normal as well. So you'll see this trend. Part of this is accelerated for what was already going to happen. Part of it is heightened because of COVID, but these trends are still happening. They've been happening even before COVID happened. We would expect to some degree that they would continue to happen.
Yeah, and I can tell you that I've lived it, right? Like I'm glad you brought up this accelerated trend stuff. If I were to be honest with you, I think people in general, I just think there's two types of people. There's people that like to live in urban centers, and then there's people that like to live in single family homes, right? So I think that's going to even out for sure, right? Because at the end of the day, we're going to have a vibrant downtown, and all these things are happening that supports that long-term growth. But that trend of people that live in these harsh climates because that's where the jobs are, right? Because that's where the original cities were settled before we had air conditioning. And that's why people live in the North more than the South. That trend has already been happening. I lived it in Miami, right? Like in Miami, there was this huge boom of New Yorkers coming down. And then Miami got way too expensive. So it's still cheaper for New Yorkers, but now Miami is way too expensive for anybody that lives there. So I'm a data point there, right? Like I came up to Jacksonville because once again, as places, as remote work is available, and there isn't this like absolute advantage of just being at right next to Wall Street when you can just have the the Ethernet that takes you straight there. That displaces people to slightly less expensive, and then it displaces the people from the slightly less expensive into Jacksonville, right? So like we have multiple feeders of the people that come straight from New York to reduce their cost of living by 80%. And then the people that come from Miami that reduce their cost of living by like 30-40%, like I've done. So, to me, it's so clear when I talk to my friends in Miami about how impossible it is to live down there anymore, even the ones that are doing really, really well and have kids or whatever, that trend of people moving to Jacksonville, moving to warm weather climates, with cities that already have somewhat of an infrastructure that is already, not that big a step down from their quality of life, and the resources that they have that I see continue to build in Jacksonville is only the beginning of that part. So I'm glad you touched on that.
Absolutely. I mean, the reasons that people were coming here were already strong indicators before all of this, right?
Correct.
You came up here before COVID
because
you saw this and it made sense to you. Now in a COVID world, that's like those reasons are on steroids right now.
Yeah, correct. Cool, man. So we got a couple more questions. Lee Bishop asks, Greg, did your cash flow on the 40 houses support your fix and flip opportunities during the bubble?
Nope.
You just stayed away from fix and flip, right?
No, we lost a lot of money on fix and flip back in the day. And it was because our fix and flip ventures back in the day were not what you see today, right? I mean, what JWB does, we build or we renovate rental properties now. We either do it for ourselves or we do it for our clients, right? One of the biggest aha moments for us was we love rental properties as far as building and taking on all that risk of construction and all that good stuff, because as soon as you get that thing done, you can put a for rent sign there, you can do some online advertising, and we're really good at getting a renter in there quickly, which when you're doing this times 500 houses a year, the holding costs are astronomical if you're waiting 3 months, 4 months, maybe 6 months to sell a house, right? We learned this the hard way. Back in the day in 2007, when we were fixing and flipping, we were trying to sell houses that were, in the nicest neighborhoods in Jacksonville, worth $350 grand. And it was really painful to get that house renovated and then to put it on the market and to watch it not sell for 3 months and to pay the thousands and thousands of dollars. And that was one house. I mean, one of the reasons why JWB is insulated right now in our model is because we have 40 houses that is because of our ability to turn this into a performing asset, whether or not a client purchases it from us, right? It's a performing asset for us. It's producing positive cash flow for us. So that's what gives us the confidence to go out and do this 500 times in a year, So we learned some lessons the hard way in the beginning. We had to sell a lot of those properties for losses, the fix and flip variety, which hurt. But it felt better when I looked at my rental property portfolio that one thing was working.
Man, I never thought about it as an entrepreneur. I never thought about the genius of this business model and this. Like, what other business model are you buying stuff to sell that if you don't sell still makes you money? That's so you guys never have to stop creating more inventory to sell to your clients, because every bit of inventory that you have can also just increase your positive cash flow. That's incredible.
It was a big aha moment for us.
Yeah, that's amazing, man. So Lee Bishop asked in the chat a little while ago, I wanted to go back to it. How many iterations of refinancing has gone on for these 40 houses after the market stabilized and interest rates have started to drop?
I think we refinanced them once. When interest rates dropped, we were able to do some really low interest refinances, but that was probably back in 2011 or so. So we still have the debt in place there. I mean, they're really low interest rates. When you're deciding whether or not you want to refinance, there's a whole lot that goes into it for us. And it's a different ball game. I mean, we have over 300 rental properties now. And so for everybody on our call here, we're going to talk about you guys getting the most advantageous rates. You get that when you own less than 10 finance properties. Once you get above 10, it becomes a different ball game. For us, we're well beyond 10 for our personal credit. And so it's a different ball game. Our rates are not as advantageous, and it comes with things like prepayment penalties and more percentage down and all that good stuff. So it's a puzzle that we put together. We look at it, but it's a lot more than just getting the lowest interest rate for us.
Okay, that makes a lot of sense. I think we explained it, Greg. I think you made me, number one, think that we are not likely in a bubble right now. And more importantly, as you say, see what people are doing with their money. More importantly, I just put a down payment. I just locked up a house that we'll talk about later on. Right. But like,
my man,
I am fully convinced that, whether or not the dynamics of what's going on right now seems to be a really fertile time to be investing. Even though things are going up, I'm so bullish on Jacksonville long-term, man. So really, really great explanation of all of it and the data. And I think it was really helpful to hear, even if this was the peak of the bubble right now, this in this asset class, that's just the wrong question.
Yeah. The question is, are you in for the long haul?
Yeah.
If you're in for the long haul, if you're in for a full market cycle, then you have mitigated a lot of risk, right? The conversation of whether or not you're in a bubble means a lot less, because we've just shown that yours truly bought at the height of the bubble. I still own those rental properties today, and they're still beating my original return expectations, because I didn't count on property appreciation in the beginning. I expected about a 10% return, and I got that from the cash flows, right? And then, oh, by the way, they still have appreciated about 3% on average each year since then. So that's all gravy. So if you can rally yourself around buying based on the fundamentals, buying for a full market cycle, right? Buying for positive cash flow, then this whole bubble conversation really is a moot point. Now, it's always nice to not buy at the height of the bubble though, right? If I could have planned it and I wasn't buying at the height of the bubble, I certainly would have done that. And then the data, of course, would lead you to conclude that we're not in a bubble at the moment.
I hate to reverse here, but Miguel Angel Sanudo brings up a really good question, which we didn't even touch on the stock market, right? Miguel Angel asks in the chat, isn't it that real estate and stock market work in opposite trends for investors, all depending on the economy? I go ahead and answer that, but I think it'd be interesting for you to talk about what you would have experienced by having invested in the stock market, and what the key differentiator that you kind of like shook me up this morning. We're like, dude, you're just thinking about it wrong, of the difference between investing in the stock market and investing here.
Yeah. So most people feel like that the stock market and the real estate market are maybe indirectly correlated, right? If the stock market goes down, real estate's going to go up, or vice versa. Most people would be really shocked to know that when you have a recession, right? Generally, recession is about GDP, right? 2 consecutive quarters of negative GDP growth is how you define a recession, but you generally have the stock market go way down, right? So you would assume that in most recessions, you probably had some loss of stocks. That is not how it's correlated to real estate, right? In 4 of the past 5 recessions, real estate values in Jacksonville have actually gone up on average over 3% in 4 out of the last 5 recessions. The one recession where it didn't happen, which one was that, Pablo?
The Great Recession.
The Great Recession, which was caused by real estate. So it's actually not correct to assume that the stock market and real estate are correlated, right? Real estate prices, as we've just talked about, are based on supply and demand. Obviously, other factors play into it, right? If there's a huge loss of wealth, that might decrease the buying power and decrease demand. So there's some correlation, slight correlation there, but for the most part, it's supply and demand. And so your real estate market can operate independently of what the stock market does, and that's just kind of what we've seen through recessions in the past. But we were talking this morning, Pablo and I were talking to him, and he's like, well, what do you think you would have, if you had put that money in the stock market, what do you think your returns would have been? And I kind of paused for a little bit, and I was like, the way the stock market works is, given a long enough cycle, right? Your stock gains most likely are going to be somewhere between 7 to maybe 9%, right? Which is pretty similar to what your returns would be in real estate if you're investing in all cash long-term, right? So in real estate, if you're investing in all cash right now, I would tell you to expect about a 5.5% return from the cash flows, and tack on 4% appreciation. You're looking at like 9.5%. So if we're looking at what the real return on investment from the stock market would be over the long haul, and the real return on investment from real estate over the long haul, they're, from a return perspective, if you're buying in all cash, they're pretty similar, right? Which might be surprising that you might hear that from a real estate guy, all right? But there's 2 main differences, okay? Number one, it's the type of income that is coming to you. So in the stock market, it's purely based on speculative gains from the asset appreciation, right? Your stock price going up. You don't get much money or any money from dividends on a monthly basis in the stock market. So there's a huge value for that, right? There's a value for all of us who are real estate investors to actually get the cash every single month. So you might be getting somewhere around 7 to 9% for the stock market, but it's speculative. You're not seeing that every single month. Whereas in real estate, if you're buying in all cash, maybe it's about 9%, including appreciation, but you've got 5.5% of that coming in cash flow every single month, which really matters. So that's one point. It's the type of return that's coming to you. And then the second point is the ability to acquire smart leverage. In the stock market, you're stuck between hopefully 7 to maybe 9% returns over the long haul, right? It's going to go up, it's going to go down, but the average is probably going to be between 7 to 9% over the long haul. In real estate, and this is why we talk so much about using smart debt, what I was sharing with you about that 9% return in real estate is assuming you're buying in cash. If you buy that property using smart debt, your down payment is a lot lower. Your initial investment is a lot lower, maybe 20 or 25%. And when you experience growth, that 4% growth from appreciation that I've been talking about, it skyrockets your overall return on investment. So that's why we work with clients, and when it's the right thing to take on financing, that's why we look at it and we say, if you're invested for the long haul, then you can count on home price appreciation. You use debt, your returns can be between or over 20% on that same asset. So it comes down to those 2 things. It comes down to the type of income coming to you, and then it comes down to your ability to acquire smart leverage that you get with real estate that you don't get in the stock market.
Brilliantly explained. Thank you very much, Greg Cohen. I want to, wrapped up another awesome hour with you, man. I missed you last week. It was great to go running with you again this morning. I am always in awe and always grateful of having 35 people with us on in the middle of a Tuesday. We still got 20, just dropped to 28. So somebody dropped off, but we just yeah, 29 people joining us to listen to us, try to explain these concepts, and you do a really, really phenomenal job at it, man. So happy to have you back, buddy. And I'll like to invite everybody to join us on Thursday when we break down an actual property, where we do the JWB rental income property of the week. And join us in the Facebook group in the meantime. And outside of that, I'll kick it off to you to thank everybody, man.
Thank you all. Thank you all for being here. Such a pleasure to be with you guys every single week. I love that we had such a great turnout today. And if you want more topics like this, whatever's on your mind, that's how we drive the content for the show. So an open invitation for you to share your thoughts. You can drop them in comments on the Facebook group. If you're members of the Facebook group, we'd love to see you there. And another reason to be a member of the Facebook group is that I do a replay of this. We do it every Tuesday night at 9 p.m. We're going to do one tonight. You just got to be a member of the Facebook group. And then I'll be in there. And, I've seen a lot of our folks, our regulars that join us live here, catch the replay because they wanted to hear it again. They maybe wanted to ask me another question. I'm there live in the watch party answering questions again. So we'd love to see you all there again tonight. And, looking forward to Thursday again.
All right, buddy. Talk soon.
All right, guys. Take care, everybody.